Welcome back to Market on Close. I'm Sam Vadas. I'm joined now by our next guest, Patrick Mueller, who's the president of Mueller Advisors. And thank you so much for your time, Patrick. Really appreciate you joining the show for this Friday. Look, we have seen, obviously, some caution going into the weekend, which has been typical the last few weeks, obviously, with the headlines that we learn about when the markets are closed and the markets have to react to on Monday. Just talk us through your thoughts as we approach the weekend with some of this de-risking and rotation going on right now.
Great question, Sam. Great to be with you. And we've been kind of waiting for a catalyst like this to be happening for quite some time. We've had the markets moving sideways since about early November. And we've been in this price home, and we've been waiting to come out of it. And I think this is probably going to be the catalyst that's going to move us out of it, where the markets are going to keep continuing to push up, or we're going to start seeing a drawback. And I think that's what people can see here in the near future, is that the markets are going to start pulling back. We might see a run up here in the next week or so, but I think ultimately we're overdue for a pullback, and things have been so overweighted towards tech, and things are rebalancing right now. So I think this is a good time for people to be taking some chips off of the table and keeping some powder dry.
Okay, then what's the catalyst for stepping back into the markets? I mean, you know, once you see that pullback, because, I mean, we've seen the average member drawdown of some of these indexes in the double digits. I mean, do you wait for some of these sectors and these sort of unloved names to show a little bit of meaningful upside to then, I guess, catch on to that train, or do you just take advantage of the dip?
Yeah, I think you take advantage of the dip. I think it's time to reposition. Like last year, Sam, we had a great year in the S&P, but you had 40% of the companies that were at a loss. And you had your top 10 companies that equated for 40% of the growth of the market last year. So things are so overweighted towards a lot of your big names. And I would be cautious of that right now and continuing to ride that train. So I personally would be taking some chips off of the table and moving things into different sectors that aren't going to be getting beat up as much in the general markets, in the S&P and the NASDAQ and Dow, and starting repositioning into different sectors.
Okay, so you're not necessarily holding on to cash, you're just rebalancing. So where are you looking? And I mean, as far as diversification, are you also giving fixed income a look, international as well?
Absolutely. International did really well last year, and so that's hard not to take a look at. But we've been repositioning a lot into fixed income, and then also sitting on about 20% in cash, so that way we can pounce when we do see a big pullback here, that we can start buying back in at a certain point and start riding that wave back up again. But some of the things that we've taken a look at, JEPI has been really good. There's a great fund from First Trust that came out, ACYN. It's a structured note ETF that's got about a 12% yield. So that has been fantastic. We're loving that. And we like that fixed income right now as we're going to be going through some of this volatility.
Okay, I mean, I'm wondering what you're thinking about, obviously, with respect to the geopolitics, but with some of the AI disruption fears in this market on top of all the headlines we've been reading about this week with respect to more red flags emerging with respect to credit risk concerns.
And as far as credit risk goes, we need to pay a lot of attention to that. We're at all-time credit card highs right now, and consumers are hurting more than it's being let on in the media right now. And people are actually refinancing their mortgages out of 2-3% mortgages, which are fantastic, and having to refi into 6-7+% mortgages just to get money out, just to stay afloat, because inflation has been such a factor over the last 4 to 5 years. The price of everything has really doubled, and even though those numbers have kind of subsided, people, I don't think, have really recovered from that, and we're really seeing that in this increasing debt. So that's another bubble that we want to be watching out for, not only the AI bubble, but this consumer debt bubble to start paying attention to.
Yeah, and this is obviously why we've seen these financials very much underperforming against other sectors, really, to start the year. Not to mention a bit of that flattening of the yield curve, no doubt, not helping. I see you mentioned utilities as well as the AI secret winner here. It's very much been seen as, obviously a de facto sort of tech play and backdoor kind of adjacent way to kind of trade this whole artificial intelligence theme. Where are you looking within utilities?
Yeah, well, Constellation has been good for utilities. We like an ETF called Grid, and to take a look at all of that infrastructure that needs to be put in place for all of these big tech companies and all the energy that's necessary. So that's going to be a huge move moving forward. Is what's going to be powering all of this stuff. So that, a good play is going towards that energy sector and looking at some of those companies and some of those ETFs. That's really going to be leading the path that way as we're seeing all these AI valuations kind of going over all the place, and we might be seeing a pullback on that, but I think the energy is going to stay strong over the next few years.
Okay, so you're looking at energy, obviously utilities, fixed income, bit of international there to diversify the portfolio. How are you thinking about some of the more consumer-facing names, just given some of the concerns out there, particularly with respect to the geopolitical situation unfolding, the energy shock, and just how people are feeling around kitchen table issues at the moment? And as Nicole Penelides and I were just discussing, this sort of low hire, low fire.
Yeah, as far as companies go right now, they're wanting to hold on to good people, and people are trying to keep that money. Companies are trying to keep that money in-house because there's a lot of uncertainty that's out there as far as where the markets are going to be going, where interest rates are going to be going, what's going to be happening around the world, like you said, geopolitically with what we've been doing in Venezuela and Iran and ultimately China and Russia, and where that's going to be going longer term. So there's just so many question marks that are out there that I think big companies are just hesitant right now, but they don't want to give up their good people. They want to be holding on to that talent. Yeah. So we'll see where things swing moving forward, but it's going to be cautious, and that's why we've seen so many swings going into precious metals, and whether it's gold or silver that have been just doing a tremendous run over the last year or so.
Although they haven't been acting as a typical safe haven in the last 2 weeks, which is interesting, no doubt pressured by that stronger greenback. So obviously something to keep note of. Let's see how long that lasts, though. But you touch on a really interesting investment theme, which I've been tracking for many, many years because I've covered both sides from here and also in Asia. And that is, of course, this repatriation of jobs, manufacturing and companies. I wanted to pick your brains about how you invest as a theme around that. I mean, what companies do you look at? What ETFs are you looking at that manage to capture some of the upside and the benefits of that specifically?
Yeah, all the reshoring that's happening right now with all the tariffs and all the moves to produce goods and services here back in the country, which I think is fantastic. You want to be looking at some of those companies that are bringing things over here. So you've got like GE, you've got Apple, you've got Taiwan Semi. So you've got these different companies that are reshoring back here, and then you've got a great First Trust ETF as well. It's just tracking that. So they've got a really good ETF when it comes to tracking those companies that are going to be starting to manufacture here and that pro-America move moving forward. But I think that's going to be a great play over the next few years.
Okay, and just as far as the tech, because I know you've written this headline that the S&P isn't the S&P 500 more, it's the S&P tech. I mean, obviously on a day like today when you've got all the Mag 7 down, obviously explains what we're seeing at a headline level. But we very much have been talking about here at the Schwab Network about how you can't be monolithic about tech right now. Which pockets excite you? Which areas do you think there are opportunity? Which do you think are areas that you would like to be a part of, because I'm thinking like memory, for instance, which has had such a big run up and you have so many people asking you questions, or is it a good time, or have I missed the boat? How are you thinking about tech?
Right now, I'm really cautious, Sam, about tech because everything is so overweighted towards tech, and there's so much money that has been fueling that, and all of that excess money is going to be coming to a halt probably, I would say around summertime. And they're going to have to post earnings, right, to back up all of these moves that they're making and throwing all this money into tech right now. So I'm really taking an opposite standpoint and not trying to be overweight in tech, being very cautious, looking at, companies that are reshoring and manufacturing here in the country, looking at energy, looking at defense stocks right now, and ETFs right now can can be a good move. So looking at those different avenues versus tech, and then I'm also a big, on value, which has not been getting rewarded lately. So when things start turning, you'll start seeing a flip towards value where you got big companies that are doing good, paying out good dividends, and hard to ignore companies like Berk B shares. So those types of plays I really like. And then also, there's never a better time when markets are at an all-time high, Sam, to take some profits, take some of that off of the table, declare a victory, and then wait for those opportunities to present themselves in the next few months.
Yeah, it's interesting. It just feels like it's week by week. The pendulum continues to swing between value and growth, and between some of the dispersion we've seen between tech as well, softwares and semis. But I mean, maybe it's just a short attention span of these markets. We'll have to wait and see. Patrick, lovely speaking to you. Happy Friday. Have a great weekend. We'll catch you next time. Thanks so much. Patrick Mueller there, RFC and President Beller Advisors.